The richest people in the world are playing a game you're not even aware of. While most people scramble to pay taxes, the ultra-wealthy have mastered a system so clever that even the IRS struggles to stop them. It's not illegal, it's not hidden, and yet it saves them millions, even billions at every single year. Want to know how they do it? Keep watching, because what you're about to learn could change the way you think about money forever. Imagine making $100 million a year and paying less in taxes than someone earning $60,000. Sounds impossible, right? Yet it's happening every single day, legally. The secret lies in exploiting loopholes, using hidden financial vehicles and structuring wealth in ways most people have never even heard of. Let's start with one of the most powerful tricks in their arsenal: the private placement life insurance, or PPLI. At first glance, PPLI sounds boring. Just another fancy insurance policy. But here's the catch: it's not about insurance at all. It's a tax-free investment machine disguised as life insurance. Wealthy individuals pour millions into these policies because any gains inside the policy grow completely tax-free. Stocks, real estate, even crypto, all can sit inside a PPLI and escape capital gains taxes. When they eventually want to access that money, they don't withdraw it. They borrow against it. Loans aren't considered income, so guess what? No taxes. It's like walking into a casino, winning big, and leaving without paying a dime, all because you played the game differently. But that's just the start. The ultra-wealthy also exploit a powerful tool called the dynasty trust. Imagine building a financial fortress that protects your wealth for generations, legally immune to estate taxes, inheritance taxes, and even lawsuits. A dynasty trust is designed to pass wealth down for centuries without losing chunks to the IRS. Some families in America have trusts that were set up over 100 years ago, still holding billions of dollars untouched by taxation. Now here's where things get wild. Valuation discounts. Let's say a billionaire owns a family business worth $100 million. Instead of transferring it directly to their children and paying massive gift taxes, they structure it as multiple minority shares. Because these smaller shares have less control, their value is considered lower, sometimes by 30% or more. That $100 million business? Suddenly it's worth $70 million on paper, legally reducing the taxable amount. It's like hiding your money in plain sight, and the IRS can't do anything about it. But what about income taxes? The rich avoid those too, with a strategy that's almost laughably simple. Instead of selling assets and paying capital gains, they just borrow money against them. Imagine owning $1 billion in stock. Rather than selling it and triggering taxes, you go to a bank, borrow $500 million against it, and live off that cash, tax-free. Elon Musk, Jeff Bezos, and Mark Zuckerberg have all used this strategy to access huge amounts of money while paying minimal taxes. Why? Because loans aren't income, they're just debt. Now let's talk about opportunity zones. A legal loophole so powerful it almost sounds like a cheat code. By investing in designated opportunity zones, wealthy investors can delay, and in some cases eliminate, capital gains taxes. It's marketed as a way to help underdeveloped communities, but for the rich, it's a goldmine. Pour your capital gains into an opportunity zone and boom, your tax bill shrinks dramatically. But here's the sneakiest trick of all: charitable remainder trusts. Wealthy individuals use these to donate assets to charity while still benefiting financially. They donate appreciated assets, avoid capital gains taxes, and get a massive tax deduction, all while continuing to receive income from those same assets for the rest of their lives. When they die, the remaining assets go to charity, but by then they've already enjoyed years of tax-free wealth growth. And if you think all this is just about clever accountants, think again. The richest Americans actively influence tax laws to protect these loopholes. Through lobbying, political donations, and influence in policy circles, they ensure these strategies stay legal and almost impossible for the average person to exploit. Now here's the kicker. These aren't illegal tricks. They're legal, often encouraged by the very tax code designed to collect revenue. The IRS knows these strategies exist, but the system is so complex and loophole-filled that they can't plug every gap. The question is, why isn't everyone doing this? Because these strategies aren't advertised to the average person. They're buried in financial jargon, tucked away in legal documents, and reserved for those with the right connections. But now you know. And knowledge is power. Here's where things get even crazier. Some of the wealthiest individuals don't just avoid taxes on their income or investments. They even pass down massive fortunes without paying a dime in estate taxes. It's called the GRAT strategy, Grantor Retained Annuity Trust. And it's one of the most powerful tools the rich use to protect their wealth. Here's how it works. A billionaire places high-growth assets like stocks or real estate into a trust. The trust is set up to pay them back a fixed amount every year for a set period, say 5 years. By the end of that term, if those assets have grown in value, which they almost always do, the excess growth gets passed on to their heirs tax-free. The original investment amount goes back to the billionaire, and everything above that is essentially a bonus, completely shielded from estate taxes. This strategy is so powerful that Mark Zuckerberg and Sheryl Sandberg have both used GRATs to move massive amounts of wealth to their families without triggering massive tax bills. Imagine handing your kids millions of dollars without the IRS touching a penny. That's what a GRAT does. But wait, there's another trick that's arguably even more powerful: the step-up in basis loophole. This one's so absurdly effective that billionaires rely on it to wipe away generations of capital gains taxes. Here's how it works. Let's say someone buys a property for $1 million. Over the years, that property's value grows to $10 million. If they sell it during their lifetime, they'd owe taxes on the $9 million gain. But if they hold onto it until they die, their heirs inherit the property at its current value, the full $10 million. And that massive $9 million gain? Poof. Gone. No taxes owed. This loophole allows wealth to compound over generations with minimal taxation. Wealthy families deliberately avoid selling appreciated assets, holding them until death so their heirs can inherit them with a completely reset tax basis. And if you're wondering how the IRS doesn't shut this down, they've tried. But lobbying power from wealthy individuals and corporations keeps the step-up in basis loophole firmly in place. It's why some of the richest families in America continue to grow their wealth while paying little to no taxes. Now here's where things get sneaky. Some billionaires take this strategy even further by combining it with family limited partnerships, FLPs. By pooling their assets into a partnership, they can transfer small ownership percentages to their children. Because these minority stakes have limited control, they're considered less valuable on paper even if they represent millions in actual wealth. This discount can reduce the taxable value of the transferred assets by 20%, 30%, or even 40%, legally shrinking their tax bill. But the real magic happens when they combine all these tricks, using GRATs, FLPs, and step-up in basis together, to create a financial fortress that shields wealth from taxes for generations.